Hey guys, I'm Eric Bramlett. I am the broker owner of Bramlett Residential. Today is January 31st, 2023, and it is literally freezing outside. All the schools are closed, the roads are icy, and we hope that you are staying home, we hope that you're staying warm, and we hope that you are staying safe. Today we're going to discuss the overall 2022 Austin real estate market, as well as our predictions for the Austin market in 2023. So let's go ahead and get started. The real estate market in 2022 is relatively easy to summarize. The first 5 months of the year, we were in the insane pandemic demand that we had all grown used to, and we saw prices increase by 18%. The Fed poured cold water all over that nationally. They tightened up monetary policy, they increased interest rates, which caused mortgage rates to rise. And then the last half of the year, the last 7 months of the year, we saw a drop in prices by the same amount, by 18%. We ended up with a relatively flat year. Overall pricing declined just a little bit. It's important to note that this was due 100% due to interest rates. The interest rates decreased buyers' purchasing power, and it decreased demand, and that's what caused fewer homes to sell, and for the homes that did sell to sell at a lower price than they did at the peak in May. So what do we think is going to happen in 2023? Well, the good news about mortgage rates is that we now have 3 months of stability. So rates stabilized sometime in November of 2022, around 6 to 6.5%, and they've remained there since up to today. If we continue to see rate stability, mortgage rate stability, you will see buyers continue to enter the market or re-enter the market. So what challenges do we see in 2023? And one challenge we see is the jobs market. So Austin historically has one of the best, if not the best, employment markets in the United States. That's something that we've all grown used to for quite some time. And you're going to see the jobs market nationally slow down, which means that it will slow down in the Austin market as well. ABJ published an article yesterday. They quoted Angelus Angelou. He said that we had 67,000 jobs created in 2022, and he predicts that we're going to have, I think it's 42 or 43,000 jobs created in 2023, roughly a 30% decline in job growth. Fewer jobs being created means fewer people moving here, fewer homes sold, so the demand will be less than we're used to due to that. What do we have helping us? Well, as long as rates stay stable, we have affordability helping us quite a bit. So at the peak of the market in May of 2022, the average sold price was $685,000. Mortgage rates were at 5% at the time, roughly. And you make some assumptions, and you come up with the average monthly payment was $4,470, call it $4,500 a month to own the average home in Austin. Whenever prices were coming down, rates were going up. There's going to be a period of transition, and in August, the average sold price was $638,000. Rates were around 5 3/4, and the average cost to own was around $4,400 a month. December of 2022, after prices had adjusted back to very beginning levels, the average sold price was $563,000. Mortgage rates at 6 1/4, and the average monthly payment was $4,025 a month. That's really great to see. That means that in December of 2022, it's 10% cheaper to own a home in Austin than it was in May of 2022. And that looks really good for us. So what are we going to watch in 2023 to see what direction the market's going? Well, as we keep saying, mortgage rates. If mortgage rates stabilize, if they decline a little bit, you're going to continue to see buyers enter the market, re-enter the market. We're going to see some decent demand. Mortgage rates are going to be affected at a high level by the Fed's monetary policy. Now, that doesn't mean that mortgage rates go up whenever the Fed raises rates. That's not how it works. The Fed's monetary policy affects the bond market. The bond market directly affects the mortgage market. Right now, mortgage rates have Fed rate increases priced in for the next, call it, 4 or 5 months. The Fed will continue to make their monetary policy decisions based on inflationary data. The best inflationary data you can watch are the CPI reports, and we'll show you a resource here in a minute on where you can monitor that. overall demand, which is another fantastic leading indicator to watch to see, how confident are consumers. That's the Consumer Confidence Index, and that measures what consumers feel, how they feel about the economy, which drives their decision to buy all things, houses, cars, luxury items, vacations, things like that. So it's a phenomenal metric to watch, and we'll show you a resource for that here in 1 second. So let's get to that. Best place you can go to look for mortgage data is going to be Mortgage News Daily. We'll share the link to this in the comments. This will show you where the rates are today, what the prevailing rate is. They'll also show you historical data if you'd like to look at historical data, and you can adjust that chart right there if you'd like to. CPI report, you can save this link or not. It's easy to just Google CPI report, and it'll be all over the news whenever the CPI report is released. The next CPI report will be released Valentine's Day. So February 14th, let's hope that they bring us a nice Valentine's Day present and the report looks good. If the report looks good, that means that the Fed will not be more hawkish, which means that rates will stay where we would like for them to stay. And then consumer confidence, we like the U.S. Michigan Consumer Sentiment Index, and we'll share a link to this. But this will show you overall like how confident are Americans in the economy. Something to observe that we've talked about a lot internally is that consumer behavior seems to be normalizing. And what we mean by that is that buyers seem to be re-entering now that we are past the holidays, and hopefully now that we're past the holidays moving into the spring months, hopefully that behavior will continue. And so a normal market, we will see the most demand in the spring months. It's going to peak in April, May, and then it'll be a straight line decline to the holidays. It makes perfect sense. Once kids are back in school, people are less motivated to move. During the holidays, nobody really wants to buy a house. And so all those reasons for why this is the way it is make a lot of sense. But here's the data. This shows you historically when the most demand is. And so, if you're a buyer, you can generally expect to see more properties on the market during the peak times, more competition. And then, obviously the opposite's true during the low times. Seller, you can expect more demand, more competition as well during the peak times. And then, the opposite's true whenever you get into the holidays. So also want to speak to submarkets. Submarkets will behave differently in Austin. The Austin market is not homogenous. So, whenever you're in the entry-level price point, we're already observing that is recovering incredibly quickly, and it's very nice to see. On the other end of it, sellers are having a harder time if they're in a newer neighborhood where builders are still delivering new inventory, new supply. It makes perfect sense. Even if demand comes back, there are more homes on the market, more competition. It's going to be harder to sell in those markets. Another submarket that's behaving differently would be the luxury market. So luxury buyers are affected by interest rates, and they're also affected by the stock market pretty heavily because they generally are heavily invested. And those buyers don't like to sell their investments whenever they're down. So we will probably need to see the stock market recover as well as rates, stabilize and hopefully go down in order for the luxury markets to come back. Now, we do expect that to come back in a pretty quick way. We expect the luxury market to be a V-shaped recovery. But again, you want to watch the stock market to see whenever we feel like that will hopefully come back. So we'll leave you guys with a quote from Angelos Angelou. It was in that same article from yesterday. Says, "It is going to be a little bit of a slowdown, nowhere near a recession as far as I can tell. The economy is still adding jobs, so it does not feel like a recession, even if it may be one. Austin is not going to be affected as much, and Texas is not going to be affected as much, and Austin is going to be affected even less. The recession is going to hit different parts of the country differently." And, this is a relatively easy thing to get on board with. Austin's always had a really phenomenal economy. We were the last out of the 2008 recession. We recovered pretty quickly. We feel like that will be the case here. And it's nice to see, one of the most widely respected economists in Texas say this to us. So those are our predictions for the Austin market in 2023, quick summary of the market in 2022. If you have any questions, if you have any feedback, or if you'd like to discuss your specific situation, I'd love to hear from you. Shoot me an email, eric@bramlett.me, or just look us up online. Pretty easy to find us and get a hold of us. Beyond that, I hope that you are staying warm. I hope that you're staying safe. I hope your kids are having fun at school if you have kids. And I hope you have a really awesome week. So thanks so much.